Today we're going to talk about the QBI deduction, Qualified Business Income Deduction for small business. We talked about it before for rental property, but it differs quite a bit for small business, so I'm doing another video so that you can, if you've got a small business, and primarily this is for Schedule C and for actually small S corporations. Not for C corporations, but there are other entities that do qualify, but for the most part it's a Schedule C type situation. So let's go ahead and get into this. You see our disclaimer for affiliate sales, our disclaimer for educational purposes, and what is the Qualified Business Income Deduction? This is the same slide actually that was in your rental display for the Qualified Business Income Deduction. So basically it allows you a 20% deduction for on your income, your net income, from a Schedule C business or from other types of businesses, which we will get into, but it does exclude, like I say, C corporations, regular corporations. So it's 20% of the income, the QBI, which is the Qualified Business Income, which is most income from a Schedule C. And then qualified publicly traded partnership income and REIT dividends. And REIT is real estate investment trusts. Most of you are not going to have either one of those, but that's what it is basically a 20% deduction on that type of stuff. And it does cover rentals. We've got another video on rentals, like I say, so we're not going to talk about rentals in this one. Who can take the deduction? We talked about that a little bit. S corporations can, Schedule C's can, trusts and estates, cooperatives. You just have to remember that the deduction is taken, it's calculated at the entity level, but it's taken at the individual tax level. And so if you're a partner, for example, in a partnership, you've got to take it on your own tax return. And same with trusts and estates and cooperatives. It's got to be taken on the individual tax return. All right. And I already said several times that C corporations can't take it. So it is subject to limitations, and those limitations are actually placed on your individual tax returns. So if your income, for example, if you're married, you can make $321,400 and still be able to take the deduction. But at that point, it starts phasing out. So between $321,400 and $421,400, it phases out. So your deduction is limited between that range, and then once you're over $421,400 or there, you get no deduction whatsoever. So that's the way the income limitation works. There are some exceptions to that, and let's talk about the exceptions real quick. If you do not qualify for the as an income, your income does not qualify, then you may qualify if you're not an SSTB. So let's talk about what an SSTB is real quick. An SSTB is a service organization, specified service business organization. So it's things like attorneys, accountants, investment advisors, that type of thing. If those types of guys cannot have to qualify on the income limitation, but other businesses can qualify on what's called the wages and property aspect of it. So and so what it says is you either qualify if you're you get 20% of your taxable income minus capital gains and dividends, or you get the lesser of 20% of your QBI or 50% of your W-2 wages with respect to qualified business income. So if you've got W-2 wages, you can qualify on those possibly, or you can qualify on 25% of your W-2 wages with respect to your qualified trade or business property, plus 2.5% of the unadjusted basis immediately after acquisition of the qualified property. So I would suggest that if your business is not an SSTB, that if you're preparing your own tax return in this situation and your business is over the income limitations, I would suggest you go find a tax preparer and CPA or another tax preparer and enrolled agent, and have them make sure that this thing is done right for your wages and property type qualification, because it's a little bit more difficult in this area. All right, so let's look at what a specified service trader business is. I mentioned to you it's an accounting, health services, doctors fall into that area, athletics. So if you're a pro athlete, for example, you're going to fall into this area. I mentioned brokerage services. It's also investing in there if you're a professional investor, professional trader, performing arts, and consulting, that type of thing. So these things are specified service trader businesses, and they can only qualify if their QBI falls within the income ranges. If their QBI falls outside the income ranges, they cannot take advantage of the wages and property type qualification. Okay. All right. But I think there's a misunderstanding that these people can't qualify at all, and they can qualify, but they're sometimes called an out of favor business versus an in favor business, which is those that can qualify with wages and assets or property. All right, how do you take the deduction? It's taken on Form 8995. That's the simplified form. And the IRS wants to confuse us here as usual, and so the simplified form is not called 8995A, like the old 1040A used to be, which was a simplified form. But it's just 8995, so that's a simplified form. And then 8995A, if you remember, is the more complex form. And so 8995 is used if you fall within the income limits. 8995A is used if you fall outside or above those income limits. And so the only people that are going to be using 8995A are in favor type businesses, which means they're not an SSTB type business. Okay. Now, so that's it. That's the important things about the qualified business income deduction for small business. And we produced a 2020 Quick Facts tax guide. If you'd like a copy of that, shoot me an email at the email michael@thevideocpa.com, and I'll send that out to you. Appreciate you watching, and if you haven't subscribed, please go ahead and subscribe. We'd like to have you on our subscription list, and you'll get notifications of future videos if you do. So thank you very much for watching.